For probably the last decade, maybe more, the gold standard in Silicon Valley, for companies like Microsoft, Google, Amazon, it was all about being asset light. That was the dream, right? Scale globally just on software, networks, IP, get those amazing high margins without much physical baggage. That was the rule. Okay, let's unpack this, because that fundamental rule, it's basically dead. The engine driving all this incredible growth now, AI, isn't just software. It needs steel, silicon, massive physical buildings. It's demanding huge infrastructure. We're calling it the CapEx wars. And the mission for this deep dive is to figure out how this massive capital spending is turning these tech darlings into, well, heavy asset giants, and how that forces investors, forces you to totally rethink how you value these companies.
That tension you mentioned, that's absolutely central. It's the clash between the old software way and this new infrastructure reality. AI is pushing these firms into a model that honestly looks more like semiconductor manufacturing plus utilities, maybe.
Yeah.
It's definitely not pure SaaS anymore. So we need to look at why it's happening and the really critical impact this has on those core financial numbers like return on invested capital, ROIC, and free cash flow.
Okay, so let's start there. The traditional model, it was elegant. You write code once, sell it infinitely. The cost to deliver one more copy, almost zero. So high margins, naturally. Here's where it gets really interesting. What specifically is happening, like physically, that's flipping this whole profitable light asset thing completely on its head?
Well, it really boils down to one thing: compute hunger. We aren't just talking about servers running websites anymore. Training these large AI models and then running them. That takes thousands of interconnected, very expensive GPUs or AI accelerators, plus specialized high-speed networking, massive data centers built to, frankly, industrial specs. I mean, look at Microsoft, Google, Amazon. They're committing tens of billions of dollars every year just on AI infrastructure.
So it's not just the code anymore. It's the sheer physical horsepower needed to train these things that cost so much.
Exactly. And those physical machines, they bring constraints that pure software just never had. That's why we sometimes call them digital factories. Think about the power consumption. AI workloads use vastly more electricity than older cloud apps. They need incredibly advanced, expensive cooling systems, sometimes liquid cooling that costs hundreds of millions for just one facility. And unlike software you can just switch off, a digital factory needs constant feeding power, cooling, maintenance, hardware refreshes. It's continuous capital drain just to stay competitive.
Right, that operational overhead sounds massive. And it's not just buying kit off the shelf anymore, is it? They're building their own stuff.
Absolutely. That's the vertical integration piece. It's almost becoming a necessity for the leaders. They aren't just buying standard chips, they're pouring money into custom silicon. Google's TPUs, Amazon's Trainium chips. Now, the idea is optimization control, getting an edge, but it ties them directly to hardware design cycles, manufacturing complexities, and these huge, unavoidable upfront capital costs. It's a complete strategic pivot from lightly leasing compute to heavy, self-driven infrastructure build-outs.
But hang on, couldn't you argue that's just the justification they give? I mean, is building your own silicon really about building an unshakable moat? Or is it maybe more defensive? Like maybe they just couldn't get enough top-end NVIDIA chips, so they had to try building their own. That adds complexity, but doesn't guarantee better returns, does it?
That's a very sharp point. And yes, there is increasing investor scrutiny on these internal hardware projects for exactly that reason. You have to ask, is this truly building a unique advantage? Or is it just mandatory spending to keep up? But, regardless of the initial motivation, the financial impact is the same. The sheer scale of the AI opportunity seems to demand this scale of physical investment. It's almost table stakes now at the highest level.
Let's look at some examples of that. How did companies actually navigate this? Because these giants aren't pure software anymore. They're definitely hybrids now. Amazon feels like the classic case study here, moving from light to heavy.
Oh, Amazon is essential viewing, absolutely. They started as that asset-light online bookseller, remember? Then came the massive fulfillment centers, warehouses everywhere, then the AWS data centers. And investors, frankly, they hated it at first. All that CapEx in the early 2000s, people were thinking, wait, this isn't a company I invested in. It caused a huge jump in capital spending and depreciation on the books. But eventually, the market had to recognize the value of those physical assets. The AWS cloud, the logistics network, they built moats, real physical barriers their rivals couldn't easily copy. AWS turned into this incredible, though capital-intensive, cash machine. So now, the market values AWS as this durable, enterprise-grade business. But critically, analysts must factor in long, ongoing CapEx schedules into their models. It forces a long-term view.
And Microsoft is clearly charging down that same path now with Azure and its AI push.
They are indeed. Microsoft brilliantly pivoted its Windows and Office cash cows into funding the Azure cloud platform. And now they're doubling down again on AI supercomputing within Azure. Investors used to value Microsoft purely on its software margins, which were amazing. Now they accept the heavy CapEx, the depreciation that comes with Azure, because they see the cloud dominance and the potential AI growth. The valuation conversation for Microsoft is increasingly about free cash flow after all that necessary CapEx. Can they still generate strong cash despite the spending?
Then you have, well, Meta. That felt like a much more abrupt, maybe even shocking, turn into heavy assets with the metaverse plans. And investors definitely reacted.
Meta is a fascinating example of the market hitting the brakes, showing its pain threshold almost immediately. That huge bet on Reality Labs, all the AR/VR hardware development, the R&D, building the underlying tech, it created massive operating losses, just huge. And those losses directly pressured their overall profits, which led almost instantly to multiple compression. Investors punished the stock. So now the market essentially treats Meta as two separate businesses. You've got the incredibly profitable ad platform, high margin, asset light, and then you have this experimental, very heavy CapEx hardware division. That heavy side creates a big discount until, or unless, it proves it can be profitable.
And finally, Tesla. Maybe the ultimate heavy manufacturing company that often gets talked about like a pure tech play.
Precisely.
Yeah.
Tesla went from this niche electric car startup to a globally integrated industrial powerhouse. Building gigafactories, battery plants, it absolutely forced investors, even if reluctantly, to start using valuation tools usually reserved for old-school industrial companies. Things like focusing intensely on factory capacity utilization, understanding deep CapEx cycles. Even though the stock still often trades at multiples way above traditional automakers, the underlying business reality is heavy industrial. So across all these examples, the physical shift demands an analytical shift from investors.
Okay, that leads us right to the investor reckoning. If building all this heavy infrastructure actually creates stronger moats, locking in customers, making it harder for competitors, why is this shift financially risky for someone holding the stock?
It comes down to capital efficiency, or maybe the lack of it, at least in the short term. High CapEx means spending enormous amounts of money up front. That spending doesn't instantly translate into proportional profit or revenue. There's a lag. During that lag, the capital is either sitting idle or it's depreciating before the revenue really starts flowing in to cover it. That creates a financial drag that pure software firms just never experienced. And the direct result is often lower returns on equity and, maybe more importantly, lower returns on invested capital, ROIC.
Wait, let's just nail this valuation shift part. You mentioned moving away from things like the Rule of 40, which was a big benchmark for SaaS health.
Yeah.
Why does that rule suddenly become, well, kind of useless when you start building giant physical things?
Yeah, the Rule of 40 is basically built on the assumption of very high gross margins, the kind you only get when your cost to serve the next customer is virtually zero, like with software. But heavy CapEx introduces massive, unavoidable depreciation charges. As soon as that depreciation hits your income statement, it hammers the profitability and the margins that the Rule of 40 relies on. It just breaks the logic. So this demands a pretty radical shift in how you value the company. Investors really have to ditch that light asset sauce, thinking, focusing on high multiples of sales, and instead adopt models much closer to infrastructure or industrial companies. That means detailed discounted cash flow, DCF models, and you have to explicitly forecast those long-term CapEx needs. And this is why metrics like enterprise value to EBITDA or EBITDA suddenly become much more relevant than EV sales.
Why EBITDA specifically? What makes that the better metric here?
It's pretty straightforward, actually. Heavy assets mean huge depreciation. EBITDA, remember, is earnings before interest, taxes, depreciation, and amortization. So it strips out that big non-cash depreciation charge. This gives you a clearer view of the actual operational cash flow being generated before accounting for the cost, wear, and tear of all that physical infrastructure. Essentially, you're shifting from valuing potential maybe at 15 times revenue to valuing operational efficiency, maybe at 8 to 12 times EBITDA. And absolutely critical here is avoiding stranded asset risk. You can't have idle digital factories or half-empty warehouses just sitting there destroying value. So focusing on utilization rates becomes paramount.
Okay, but it still feels a bit counterintuitive sometimes. Why does the market still seem to treat some of these companies like Amazon or maybe Tesla, like high-growth stocks, giving them premium valuations despite all this capital intensity and potentially lower ROIC? So what does this all mean for how they're actually priced?
Yeah, it's a great question. It seems to boil down to two main things: narrative and segment separation. Investors get captivated by the big growth stories, AI dominance, autonomous driving, the energy transition. They often mentally frame all this CapEx as purely investment for future growth, and they tend to overlook or at least discount the immediate financial drag from depreciation and lower near term returns. The other really key factor is what analysts call sum of the parts valuation, or SOTP. It's a bit technical, but basically, the market doesn't always value the company as one single thing. It mentally breaks it up. Investors kind of carve out the parts that are still inherently asset light. Think AWS's software and services layer, Meta's ad platform, Tesla's software and autonomy potential. These parts are seen as pure cash engines and can still command really high multiples. And those high multiples on the good parts effectively help prop up or subsidize the valuation for the entire company. So they end up in this kind of middle ground. The growth story supports a premium, but the heavy asset reality puts a cap on it, preventing those crazy pure size type multiples.
Right, zooming out a bit now, this massive spending isn't just about a company's internal strategy, is it?
Yeah.
It feels like a global competitive necessity, especially when you think about the US-China AI race.
Oh, absolutely. The CapEx wars are completely intertwined with geopolitical strategy now. It's become a prerequisite for maintaining technological leadership. Both the US and China are locked in these massive infrastructure buildouts. Currently, the US probably still has an edge in the most advanced AI models and the underlying chip technology, largely thanks to access to NVIDIA's top-tier GPUs and leading R&D. But China is moving incredibly fast to scale up its own training and inference capabilities. You see huge state-backed initiatives. Think about projects like the Stargate of China. These are massive, often heavily subsidized infrastructure plays designed to build national AI champions. It highlights an interesting dynamic. US companies like Microsoft and Google face market-driven CapEx pressures, whereas Chinese companies sometimes face strategic CapEx directives from the state, which, could increase the risk of building stranded or underutilized assets if the pure market demand doesn't quite match the state's ambitions.
That's a crucial distinction. So it really comes back to capital efficiency, doesn't it? It's not just about spending big, but spending smart. Does the heavy spending actually generate dominant returns?
That is the absolute crux of it. It all comes back to ROIC, return on invested capital. The market ultimately rewards smart CapEx, not just high CapEx. Look at TSMC, the chip manufacturer. They spend insane amounts, maybe $30–40 billion a year on fabs. Super heavy asset. But they have near monopoly pricing power and leading edge chips. And they deliver consistently high ROIC, often north of 20%. The market rewards that discipline with a rich valuation multiple. Contrast that, maybe, with Amazon versus Alibaba. Amazon's heavy spending on logistics and AWS clearly reinforced its competitive moats and was eventually rewarded by the market. Alibaba also spent heavily on logistics, but often felt more defensive, and it got tangled up with regulatory pressures and maybe less consistent execution. The result: multiple compression for Alibaba. The difference often lies in that disciplined capital efficiency.
That clarity is really helpful. So for our listener, the learner, who's trying to navigate this complex shift, what's the essential checklist? What should they be asking when analyzing these newly capital-intensive tech giants?
Okay, I think there are four critical questions you absolutely need to ask when looking at a company making this light to heavy transition. First, CapEx type. Is this spending genuinely driving growth, capturing market share, or is it more like unavoidable defensive maintenance just to keep pace? Big difference. Second, ROIC. Critically, will this investment earn returns above the company's weighted average cost of capital? It's WACC. If the ROIC is consistently below WACC, the company is technically destroying value with that spending, no matter how strategic it sounds. Third, has the valuation anchor shifted? Are you or the analysts you follow still clinging to EV sales? Or have you properly transitioned to using EBITDA and rigorous DCF modeling that accounts for the CapEx? And finally, fourth, strategic moat. Does the CapEx genuinely widen the company's competitive advantage, lock in customers, create higher barriers to entry? Or is it just costly defensive spending that doesn't fundamentally change the competitive landscape?
So we've seen AI is forcing this fundamental change in how tech giants allocate capital. They're transforming from software darlings into these complex hybrid industrial or utility-like platforms. And the key takeaway for you, the investor, is that you have to shift your analysis. Move away from just chasing rapid margin expansion and instead rigorously model capital efficiency, asset utilization, and the discipline of that investment.
And maybe here's a final provocative thought for you to chew on. The market still grants some of these heavy asset companies, especially those with really powerful narratives about the future, think Tesla and autonomy, or the biggest cloud players dominating AI. It still grants them huge growth valuations. We constantly have to ask ourselves, how long can that powerful narrative effectively suspend disbelief? How long can it prevent investors from fully applying the cold, hard math of traditional industrial valuation metrics, things like explicit depreciation, capacity utilization analysis, tough ROIC hurdles that the sheer scale of these physical assets fundamentally demands? When does the industrial reality fully catch up to the tech narrative in the stock price?